Hi, good morning, Rob with ShopProp Realty and Our Capital Group. I just wanted to say with ShopProp real quick before I get on to the Case-Shiller Index and a couple of charts that I picked out for you regarding home prices. I wanted to say thank you to all our customers. This has been our biggest year as far as money back into our clients' pockets. Our biggest rebate this year was over $50,000 to one client on one purchase. And we're approaching the $4 million mark when it comes to money back into customers' pockets. And thanks for helping us change the way people buy and sell real estate. It's going to be more beneficial. The more people that help us with this mission, the better it's going to be for consumers by making it less expensive to buy and sell homes. And by that obviously means more equity, more money in clients' pockets. As far as our capital group, you know that our capital group, we buy and sell properties. This has really slowed down as a lot of properties, obviously it's very competitive right now. So we haven't done that many transactions or investments this year. We buy and sell for our clients our best this year. We have had some winners, although they've been few and far between. And here's our buys and sells so far this year. So we've had some nice winners this year, but again, they've been few and far between. So finding those deals have gotten a little bit more challenging and probably will continue to do so. As we continue to get tighter on inventory, which I think might happen because of this. I'm going to switch over to the full view. What we saw in the Case-Shiller Index is what we were talking about when we saw this 2013 spike. This is the Case-Shiller Home Price Index as far as year over year return. Remember that. And so what we're seeing in 2013, remember we saw the 13 to 14% range. We're not going to obviously be able to sustain that, just like back in 2006 and 2007. We couldn't sustain the 16% rate that we saw. We've drifted back down to actually a more realistic range, which is 4% year over year. And we might stay there. And as we approach the end of the year, we tend to even slow. So this could drift down to a 3 or 2% year over year return as we approach the end of the year, and then pick up again into next year, maybe back up into the 4 or 5, 6%. These are the home prices. I still believe that we're going to see the National Home Price Index move through highs. I think that's probably going to occur sometime next year or early in 2017. That's my belief. So we still have a little bit of a move up, right? We still have around a 10% move in most 20 city composites. So we still have a nice move, and then we might expand from there, depending obviously what's going on with the overall economy. A couple of charts that might push us through there, even though again, you know, as far as overall, we're seeing a little bit of a softening, but 4% year over year return is still above the average, believe it, rate of return for real estate, which is just over inflation. The reason why it tends to work out well is obviously people are living in homes, they're paying off mortgages, so it increases the overall rate of return. But a couple of interesting charts to take a look at. This is one of them. This is regarding home mortgages, and I think this actually could help the overall market, because one of the things that has been missing is new home buyers. They're still a little bit nervous. Just like in the stock market, people say we lost a decade of investors. We had 2000, the crushing Nasdaq, where we had the tech bubble, and that was big for investors. And then obviously the 2006, 2007 crash and 2008 crash. That whole decade of investors has made people leery to get back into the market. New home buyers have also been a little bit leery about getting into the market. That coupled with the idea of home mortgages being very difficult to get into. So this is 2008. If you look at this, these are all prime, subprime, non-traditional mortgages. This is the demand, and as you can see, the demand dropped, but really that was because of the lack of availability. And here you are obviously seeing that continue, this trend over here continue. But the interesting thing, if you look at the demand and you look at what's going on with the overall mortgages, it's getting a little bit easier to get loans. as you can see from here, this is starting to rebound, which is making it available. And obviously, the easier it gets to get a loan, the more buyers can come into the market. So it's nice to see some of that restrictions starting to ease. There's even some subprime mortgages back on the market, and it's making it easier for people to be able to buy real estate. And that'd be good for new home buyers to get in, because new home buyers are better than investors. It makes it a stronger overall market. So I think that we could see that. I think that from that standpoint, again, as long as the overall economy stays together, we should break through these highs somewhere, like I said, 2016, late 2016, mid 2017 is my thought. So hopefully everybody has a great day. Take care. And again, thanks for helping us out again with ShopProp. We're really trying to help, obviously, the overall consumer when it comes to putting more money back in their pockets.